everyone, and welcome to today's webinar about the future of oil prices, or what's next for oil prices. So first we're going to talk about the upcoming OPEC Plus meeting, which is one of the key events for oil markets, and then we're going to highlight the top factors behind the current rally that we're witnessing for a while, and then what are the risks to this rally, when this rally could stop, and after that I'm going to do a technical analysis on WTI. So first, let's start with a chart showing oil prices relative to gold and the commodity index since the beginning of the year. So this is the year-to-date performance. You can see gold is down, started the year a little bit up, and then went down almost more than 10%, then back towards opening levels, and now we're down 7.33%. The CRB commodity index is up 25.94% on the year. While you can see here the Brent and crude, the crude is in purple color, and the Brent is in orange, 45% for Brent and 51.96% for crude. So you can see that oil prices were progressing strongly relative to commodity index and gold. So first let's start with the OPEC meeting plus OPEC Plus meeting. What are the possible scenarios? What could be waiting for oil markets? So just to do a small recap on what the OPEC producers did last year. So last year started with COVID outbreak, and then we had a price war between Russia and Saudi Arabia, which drove prices towards negative amid a drop in demand due to the COVID-19 outbreak. So there was no demand. The demand fell by almost 15 million barrels from its normal levels, and supply was being pumped to the market. And this caused storage to rush out or to lessen, and then we saw negative WTI price on the 20th of April 2020. So what happened after oil producers tried to reach a deal in order to put all their clashes aside, just to try to stabilize the market and save the market, because a long duration with oil prices and levels below $20 is just catastrophic for oil producers. So what they agreed on is to go for a plan to cut almost 10 million barrels out of their supply. Mexico refused to do so. We were left out with 9.7 billion barrels for a few months, and then as the prices started to recover a little bit, producers relaxed this production to 7.7 million. So they added additional 2 million barrels to the market. At the beginning of the year, they were supposed to inject another 2 or to add another 2 million to the market, bringing the total cuts to 5.7 million only. However, we saw another outbreak following the new year, and many countries went into lockdown mode again, citing European countries. Also, we saw a huge outbreak in India. So this affected demand, and producers were just cautious about adding more supply. So they only added 500,000. As COVID-19, the third outbreak, just picked up significantly, Saudi Arabia just voluntarily reduced 1 million barrels from its production for February and March, and extended it towards April. And this was a huge boost to the market. The prices were back then almost around $48 for the West Texas Intermediate. Now we're trading almost at 73. In April, the committee agreed to return 2.1 million barrels on different segments to the market, in additional to the Saudi oil, the 1 million barrel that Saudi Arabia voluntarily cut. So we were returning 2.1 million barrels until now. So now the meeting will be to decide on the production going to August and maybe further. So what the market is currently expecting is a cut or additional production. So a cut to the cuts. 500,000 barrels. So currently we're almost near 6 million barrels of cuts. So around 500,000 could be 5.5 million. We're talking about 5.5 million barrels in cuts. So this is what the market is currently expecting. However, there could be some surprises since the prices just extended to the upside. Some producers, they're just fine with adding their production. They want to benefit more from these prices, and they're fine with some setbacks in prices, 10%, 15%. Setback in prices. It would bring us back towards the $66 per barrel or $60 per barrel, which is also good price for oil producers. So watch out for these surprises because they could impact the market. This is what we have to watch out for the meeting. if the market, if they announce only 500,000, the market could react even positively, since 500,000 is just nothing with the current demand. Demand is picking up. Asia's demand is picking up again. India's demand precise after the COVID outbreak. The activity in Europe is picking up. In the United States, the driving season also is strong, and we're seeing a drop in inventory. So all these factors, with only returning back of 500,000 barrels to the market, is just positive for oil prices. The surprise to the upside could weigh on prices. So if we see a 1 million barrel or even more, this could weigh on prices, and we could be seeing a little bit of a pullback in prices. Some producers could ask for bigger returns as prices continue to move higher, as I mentioned. A clash at the meeting is oil negative. So if they weren't able to reach a deal, this means that oil producers, they are fighting again. And since they are fighting, they will be fighting on the market share. Fighting on the market share could just get bigger and bigger. And this could lead to the disruption to the full plan. And maybe we could be entering a price war if the producers, they weren't up to the market event that we're having. Reaching a deal in a fast manner is also positive to prices, which could rally significantly. So this just implies that producers are on the same page. They are ready to sacrifice more of their production to just stabilize the market and support this uptrend of prices. So these are the possible scenarios that you have to look out for, and these are their implications on the market. Okay, so now let's move to the factors that were supporting this upside rally since the beginning of the year. Also, you can just mention since April last year, since May last year, OPEC Plus was production plan was one of the key the backbones behind the current rally. However, starting this year with vaccination rollout, we started seeing a pickup in economic activity, and this just supported. So for the number one vaccination rollout, we're seeing a huge, fast vaccination rollout. Almost 3 billion doses have been administered around the world, especially in the top countries, United States, United Kingdom, Canada, and the Euro region. Also, the vaccination rollout is picking up. In China, it's also good. So all these top countries, they're going fast on their vaccination programs, and they are trying to reopen their economy as fast as possible. We have some headwinds. We'll talk about them and the risks to this rally. So the vaccination rollouts, economy reopening, they're behind such factors. The activity is just picking up again, and as long as activity is picking up again, this means that demand is also going higher. As demand goes higher with the current supply plan from top oil producers, this is oil positive. OPEC Plus production plan, as we mentioned, their cuts or their proper dealing with the situation last year was just very strong and solid, and it was very rewarding. We saw prices going from a negative in April 2020 to almost $74 as of today. So this is just more than a success for oil producers. Failure of reaching a nuclear deal. So this also was on the headlines at the beginning of June, late May. Also, we were talking about a lot of negotiations happening between the world superpowers and Iran. They're trying to revive the nuclear deal that Obama administration signed with Iran, and then Trump abandoned. So there's a huge hope for reaching a deal. However, the recent failures that we witnessed after the market was a bit optimistic of reaching a deal. So this was weighing a little bit on the market, on oil prices, as reaching a deal means more oil supply to the market. As long as the chances of a deal just receded a little bit, we saw prices pumping higher again, breaking above $70, as we are postponing additional supply to the market. The dollar weakness, we saw a dollar weakening last year. This year it's only up 2%. I have some charts, so we're going to talk about in a few, describing all these factors. Also, the dollar weakness was supportive for oil prices or for commodity prices in general. Falling inventories, we're seeing inventories in the United States, they're going back after reaching top levels April last year. The inventories were full, all the storages were filled. Demand was less back then, supply was more than expected, and this just led to capacities running out of storage, and this back then weighed on prices. So now, as long as inventories are going down, so any headwinds for the market producers, they can just fill in the inventories and just avoid additional market supply. So another one of the key factors supporting these the rally is shale oil activity in the United States didn't pick up as expected. So also I have a chart on this, so we're going to talk about it. But the market was expecting that U.S. producers will come back to the market as soon as prices go back above $50 a barrel. Now the prices are at around $70 a barrel, and still the activity in the United States is shy relative to prior times. So here, let's start with the U.S. active cases. We're seeing active cases dropping to almost 4,000 as of yesterday, after peaking at around 300,000 following the New Year. So this is just a great achievement for the vaccination programs. As long as these active cases they're going down, the economy will be open in a faster manner. This is the dollar index against oil prices. So you're seeing this is the negative move in oil prices, and this is the move higher. Now we're trading almost near $74 a barrel, while the dollar index fell from 103 almost towards the 90 level. So you can see this depreciation in the dollar index while appreciation on oil prices. It's not a very positive correlation, but still it is good to be mentioned, as long as the dollar weakness is supporting commodity prices. The falling inventories, as we said, so inventories were topping April last year near almost 540,000 barrels, 440 million barrels, and now we're back to almost 460 million. The U.S. Energy Information Administration also will be reporting the oil inventories in a few. Oil versus rigs. So in orange you can see the oil rigs in the United States, and in purple it's oil prices. So as you can see, they have a certain correlation. As oil prices go down, the rigs will go down. When oil prices start to go up again, oil rigs follows. This means the production is moving higher. So here, if you can compare to what happened in 2016, as oil prices started to recover, the production activity also picked up, and we saw rigs number going higher again. However, this time you can see oil prices soared significantly, and the prices reached their highest levels since 2018, but still the oil rig activity is very shy relative to prior levels. If the oil production activity or oil rigs number picks up to the prices, we're going to see prices going down again. We're going to talk about this and the risks ahead in a few. So what are the risks to the current upside rally? We have a couple of risks that we have to watch out for, and they could just change what's happening in the market. First, as I mentioned, COVID-19 variants. We heard a lot of variants Theta and Beta, and currently the Delta variant, which is a little bit worrisome to many nations. We started seeing cases rising again in the United Kingdom. However, what matters whether we have fatalities. So this is what matters. As long as the cases are going higher, but the vaccines are doing their work, they're efficient against the current variants, the economic activity will continue to progress. However, when we see a rise in deaths, and this could definitely force countries into lockdown mode again. Reaching a nuclear deal with Iran. So as we know, since Biden came to the White House, the Iran just raised its production again, hoping that the Democratic Party would be less of an offensive counterpart to Iran, and this was just supportive to their production. So if we go back to negotiations and they announce a deal, this will definitely weigh on oil prices, as it means we have additional supply coming in the market. And this also will create clashes between OPEC Plus, since Iran now is not really intervening with the quota. However, when Iran is back to the oil market, definitely other producers will have to cut their production to make room for Iran to join the quota, and then we're going to see clashes between these members. Also, there are some talks that the production activity could pick up to 4.5 million barrels and even more. So we're talking about 3 million barrels of additional supply to the market. The clash between OPEC Plus members, as I said, there are a couple of reasons that could lead to clash. Market share clash with prices reaching above 70, and also if Iran goes back to oil markets, this could lead to clashes between OPEC members. Green energy, so we know there's a huge rush to industrials, to renewables, and green energy, especially with Biden administration supporting this transformation. So definitely this is a long-term threat to oil prices and to fossil fuel demand. Pick up in US production, as I mentioned a few moments ago, that the production in the United States didn't pick up much for recently, and it is supporting prices. But if we go back to previous levels, to pre-pandemic levels, this means that we're pumping additional 2 million barrels to the market. So 2 million from the United States, 3 million from Iran. This would lead to an excess of 5 million, and definitely 5 million barrels, and definitely this could lead to a drawback in prices. So here, let's start with the COVID variant in the United Kingdom. These are the cases. As you can see, following the strong vaccination, cases were almost doomed. However, we're back to scoring almost 20,000 cases per day. Nuclear deal with Iran. This is the production, the Iran oil production. You can see how it picked up following Biden's election. So the activity picked up from almost 2 million barrels to 2.5 million barrels production. There are some talks that this production could be restored towards 4 million barrels. So this year was the drop ahead of Biden, ahead of Obama's deal. When Obama was able to strike a deal with Iran, the production went back almost to 4 million barrels. And then President Donald Trump, when he abandoned the deal, also the production fell again towards almost 2 million barrels, and now the production is picking up again. Green bonds. This is these are the amounts, or the issued amount of green bonds. So this means that there are more adoption for green investments, and this could just signal that oil prices could be under pressure on the long term due to the adoption of renewable energies. You can see almost 250 billion, 270 billion in issued amount, closing into what we got last year, and we're still in the first half of 2020, moving to the second half. U.S. production, you can see how U.S. production stalled near almost 11 million barrels after peaking near 13 million ahead of the pandemic. So you can see 13 million dropped towards 9.5 million almost, and now we're back to 11 million. So what if oil or U.S. production goes back above 13 million? So this is just adding another 2 million barrels to the market. This is the seasonality production for the past couple of years in the United States, 2018, 2019, 2020, and 2021. You can see the activity production last year dipped due to COVID, and then this year, the activity is trying to pick up. Normally towards the end of the year, July, and going forward towards December, the activity picks up. So if it picks up by around 1 million barrels, this also this means a lot to the market. So these are the risks to the current rally. What are big banks expecting for oil prices? So here we have 35 big banks, or 36 for this year. Their expectations for oil prices for WTI in precise, they are expecting for 2021 the mean or the average of these expectations was around 64.54. We're currently trading at 74 per barrel. The median of expectations was 64.66. The highest forecast was 70, while the lowest was 51. So now we're trading even above the highest forecast of one of these 36 banks that suggested for oil prices. However, you have to keep in mind that these prices could be adjusted anytime. Going to 2022, also not significant to change in terms of mean and median, almost around $65 per barrel, while the highest forecast is around $77.77. So maybe this could be the coming target. We're going to talk about this in the technical analysis because we're just getting closer to such levels. The big banks forecast for Brent also sitting around 67.5 for the year, 67.92 the median, while the highest forecast was 73. Brent prices reached almost 76 recently. So this is also above the bank's expectations or the bank's forecasts for the year. This could be also adjusted soon. Brent versus WTI, I just want to hint for you on one thing that's happening in the market. You can see the spread between Brent and crude. So in orange, this is the Brent oil, and in purple, it's the crude oil, the WTI. So you can see how the gap was big, or the spread between them was big at a certain time, and then during the drop in COVID, the gap just was reduced, and now the gap is also getting tighter again. So some people would trade this gap, so they believe that there's a premium to be paid on Brent relative to crude, so they go long on a certain and they go short on another. This could be one of the things that oil traders do look at. Some other, they just short the spread, so if the spread is big between Brent and WTI, they try to trade the closing of the spread. So this is just, I wanted to hint up this for you between Brent and WTI. Now we're going to move to the MetaTrader 4 platform to do some technical analysis on the WTI. And after that, we're open for any question. So here, as you can see, this is the WTI. We're going to go to the daily chart. You can see a clear uptrend. We're finding support. I'm using the 21-day exponential moving average and the 200-day exponential moving average with RSI 40 with levels 70 and 30. So you can see here the prices were overbought for a while, but now we're back below 70 level. The prices were finding support recently near the 21-day exponential moving average. So you can see here the support that we are finding recently. So watch out for any break below the 21-day exponential moving average. This could mean that prices could be heading for a bit of a correction. As long as we're above it, the market is still positive, or the move is still positive. So the dip towards this level is being bought. Another note we could be forming this channel. We could be trading in this channel here. So you can just link it and go for an extension, where the top of this channel is also coinciding with the previous top that we reached back in 2018, which is currently which was around 76.70, 76.80. So watch out for this possible target. This could be one of the targets why some of the forecasters with big banks just noted for $76, $77 as a higher forecast. This is the highest level reached since 2018, so keep an eye on this level. We're currently struggling near its previous top. So we had previously a top here near almost 74, and then the market corrected back towards $64 per barrel, and then moved back towards a new high of 76.70 almost. So watch out for a possible similar move here. This is on the daily chart. A break below the 21-day moving average could just lead to a bigger correction again to previous top of 68.13 and maybe even more. I'm going to just move to smaller time frames to try to see whether there is a certain formation. You can see how here we had an aggressive uptrend. So we were having higher highs and higher lows with a certain gap between the highs and lows. However, now we're trading more into sideways up instead of moving just in a clear uptrend. So watch out for a certain exhaustion here. OPEC Plus remains a key. OPEC Plus meeting remains a key factor or key driver for the market. Any surprises on positive supply could just drive the prices back lower towards the 200 H4 exponential moving average, which is currently receding near 69.40. You can also draw this trend line combining these previous lows we're currently trading. Yesterday we found support exactly on this trend line, which is almost coinciding with the 21-day exponential moving average, making it a key level. Any break below this trend line could mean that the current uptrend is being violated, and we start looking for levels where the market could be correcting to 69.57, which is a previous bottom, and it coincides with the 200 H4 exponential moving average could be the next target to the downside. While on the upside, we continue to monitor the 76.80 level that we talked about. Also, you can draw this channel. It's clear, so you can just trade the boundaries of this channel. So you could expect the market, if the market is going to move higher again, we could be expecting 75.30 as a first support ahead of the 76.60. So these are the possible scenarios for oil prices. Also on the hourly chart, it's similar to what we just mentioned on the H4. However, we were finding support towards the dips, towards the 200-hour exponential moving average. So this was supporting the prices. Watch out for any violation and a drop again below the levels that we mentioned a moment ago. So this is all for today's session. I'd just like to remind you that all the information, news, analysis, and opinions mentioned in this session, they're only for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument, and ICM doesn't provide any investment advice. I'm open for your questions, so you can just write any question and we will be responding for it. So please, if you have any questions, please write them down. Okay, so there's a question on whether oil prices are supporting the Canadian dollar. Yeah, we have a good correlation between oil prices and the Canadian dollar, since Canada is a good importer, a good exporter for oil. However, what's mattering most for the Canadian dollar is the monetary policy of the Bank of Canada. Recently, we saw some tapering movements, and this was just supportive for the Canadian dollar. But now we're trying to just monitor this in addition to oil prices movement. So you have to keep an eye on the monetary policy adjustments from the central bank and on oil prices. How can I trade the spread through the MT4 platform? So this spread it depends. So if, for example, if you believe the spread is wide, you just you want to trade the close of the spread. So you sell Brent and you buy WTI, for example, and vice versa. So the spread, it means when you have a gap between something. For example, if you have, let's say, for example, you believe like an ounce of gold should buy you 50 ounces of silver, and the current ratio is 70. So what you go for is you buy one and you sell another, hoping for this ratio to close again. So now the ratio between Brent and the crude is almost $1.5. So if you believe this could go higher again, so this spread is going to go back to $3, $4, you buy one and you sell the other, and vice versa. So it depends on how you want to trade it. In order to add it on the platform, you just click on, you go to, okay, so you go to platform. Here you can go to this, and here you can just click on symbols, and you can add whatever you want. You can add oil through cash CFDs, so you have energies, WTI, and Brent. So energies, spot energies, you can find it Brent and WTI. Okay, so this is how you can add. You can also add futures if you want to trade futures. CL U1, Q1 and BR U1. These are the futures of the future contracts for oil. Any further questions? How you can insert it in the PM? Like I explained to you, sir, how you can add. I just explained to you how you can add it. You just go to the platform, click on the market watch, and you can just click on symbols, and you can add whatever you want. So for example, if you don't have the spot energies, you just double click on it. So this is because it's available. You double click on it until it's yellow, or you just click on it and then click on show, and then it will appear in your market watch. Any further questions? No, definitely you can't. The MT4 doesn't support a couple of two instruments on one chart. Definitely not. It's another platform. It's Reuters terminal, so it's Icon Reuters. It's not MetaTrader 4, so you can't have them on the chart. Perfect. I believe this is it for today. Thank you all for joining. Sir, for the charts, as I said, you can just go for TradingView could support you if you use TradingView for charting. It also could help you in plotting the chart one against another. I'd just like to remind you that all the information, news, analysis, and opinions mentioned in this session are only for educational purposes and shouldn't be taken as a signal whether to buy or to sell any financial instrument, and ICM doesn't provide any investment advice. This is all for now. Thank you all for joining.